One of the questions that I get a lot is which is better, conventional loan or VA loan? So this video is going to cover the differences between a conventional mortgage and a VA mortgage and how I would suggest looking at both. Now, first of all, it's good to work with a lender that does both loan types. If someone's like, conventional is always better, that's not the right lender. At the same point, if someone's saying VA is always better, that's not a good lender either, because it's not always true. It's going to depend on the circumstance. So as we know, a VA loan needs to be owner occupied, meaning you're going to live in the house. So if you're doing the zero down, VA is going to win versus conventional. VA is going to win versus conventional unless you're putting 20% down. So if you're doing 3% down, 5% down, 10% down, 15% down, you're gonna see more savings with VA because there's no mortgage insurance. That's the trick. Conventional with less than 20%, you're gonna have mortgage insurance, which is a monthly fee that doesn't protect you, it just protects the lender in case of default. The other thing is that VA traditionally has lower interest rates than conventional, and that's regardless of down payment. If you're talking to a lender and they're like, oh, well, conventional rates are better than VA, that doesn't make sense because VA loans are partially insured by the government, which makes them very low risk, which is why they have better rates. Even with lower credit scores, a VA loan is gonna have a better rate than a conventional mortgage. So it's really important that you notice that. So less than 20% down, VA is gonna win because it doesn't have the monthly mortgage insurance. Now, sometimes people go, well, Jen, VA has a funding fee and conventional doesn't. VA has a funding fee if you do not receive VA disability or, there's exemptions to the funding fee, such as receiving a Purple Heart. So you may have the funding fee, you may not. If you don't have the funding fee, it's really clear. If you do have the funding fee, the mortgage insurance and the higher rate is still going to be more expensive than the funding fee, okay? And the funding fee does get rolled into the loan, but of course that's still a cost to consider. Now, 20% down, okay, 20% down if you're looking at VA versus conventional, it's if you don't have the funding fee because you receive some sort of VA disability, VA should have the lower rate. Okay, and I say that because it's just like I said before, VA is partially insured by the government, it's a lower risk loan. So if I have a disabled veteran, whether they're putting down 40, 50, 60, 70%, we're generally gonna be going VA because the rate is so much better than conventional, okay? Like when I'm pricing out, like I'll see VA be 0.5% to 1% lower than conventional mortgages. That's the rate differences I see. Also, if you don't have good credit, the rate differences between conventional and VA are even more dramatic, and VA is winning. Now, if you have to pay the funding fee and you're doing 20% down, as I film this, that amount would be 1.25% for the funding fee because you're doing that larger down payment. Now, what we would be looking at is, okay, how much is the funding fee? What is the rate we could get with VA? If I look at a conventional 20% down, and let's say instead of that 1.25% funding fee, I'm looking at what would the rate be if I bought 1.25 points, because that's what it equates to. If the rate on conventional is lower, fantastic, conventional we go. If it's not, VA, okay? So it's important to know that as a lender, I'm always thinking of both options, but there's certain scenarios where it's just a slam dunk. It's like, if you're doing 5% down and you have a 640 credit score, even if you have a 780 credit score, I'm gonna do VA because of the lack of mortgage insurance. So something for you to keep in mind. Now, there are certain circumstances where conventional or even FHA may make more sense, and that would be if you're buying a home with someone you're not married to who's not military. So if you're buying a house with a girlfriend or a boyfriend, VA does have a down payment requirement if they're not military, okay? If you're married, they don't, but if you're trying to buy with a boyfriend or a girlfriend, well, in a situation like that, VA is generally going to have a higher down payment requirement than conventional or FHA. So really the only times I'm going to be looking at conventional or FHA as an option is if you're buying with someone who's not military, okay, that you're not married to, number one. Number two, on multi-units sometimes, because the VA requirements in order to use rental income are a little more stringent. And if you are putting down 20% plus and you have the funding fee, which would be 1 1/4, I'm going to be weighing out conventional versus VA, okay? So that is what I'm going to be looking at as a lender. It's important to just make sure you're working with someone that understands all programs so you're not being steered in one direction or another. And I know someone's going to be in the comments saying, hey, well, aren't VA loans harder? Nope, they're not harder. Don't they take longer? No, they don't take longer. So really, when you're comparing VA versus other loan programs, it's just a math problem. Thank you.